All right, we're discussing entrepreneurial financing right now. This is the spectrum of potential places to raise financing. And we are talking about the bank loan area, meaning we're not as simple as borrowing money or using your own money, and not as complex as maybe VC funding. But if you're going to take a bank loan, they either come in the form of, for simplicity's sake, home equity loans, small business administration loans, and what we're talking about right now, which is commercial loans. So if you're going to go borrow money from a bank just as a straight commercial loan, this is a relatively onerous and controlled area of lending. Unlike a home equity loan, which would be simple by comparison, there's a bunch of things about commercial loans that you should understand that you're going to need as an entrepreneur. Number one is they're not insured by the government like an SBA loan, so that you can imagine banks are a lot more careful and controlled about who they lend to. Because if you don't pay them back, the bank just loses the money. It's not like the government covers the loan like an SBA loan. So you'll notice that the rules associated with commercial loans are going to be a lot stricter than with SBA loans. So there's more onerous requirements. The concept behind a bank loan is that you pay interest over time on that loan. So the bank is in the business of making money, but they would also like your business to succeed, but only so you can pay them back their loan. You also must have collateral to get a commercial loan. It's not like you can walk into a bank with nothing and they'll loan you money because you have a good idea. You have to say, oh, I'll put up my buildings or my equipment or my physical assets as collateral. So that if you do fail on the loan, at least the bank will be able to have some claim on a physical asset. There are different kinds of loans. That's what this is. I'm going through the very basic overview of commercial loans, but there are term loans, credit line loans, and letters of credit. Term loans are what they sound like. I'm going to lend you money over a certain period of time and you have to pay me back. Credit lines are this money sits there and you don't borrow it until you call on that line of credit. And when you call on that line of credit, then you start to have to pay interest on the amount that you've taken out in your credit line. And then a letter of credit would be another institution somewhere else can make a payment on your behalf, and your bank will guarantee that payment through a letter of credit. So those are various ways to borrow money. And just kind of as a reminder, remember that if I borrow $100,000 and I have to pay a 5% interest rate annually, and this is day one, if I'm paying on an annual basis and not on a monthly basis, at the end of the first year, I would have to come up with $5,000 as my interest payment to cover my interest payment. So I'm sure most of you have loans in real life, so of some sort, either car or mortgage, so you understand this process of paying back principal and interest at the same time over the course of time. So I won't go into that too much, but the idea around commercial loans is that they're going to earn interest income from you. So I told you these loans were limited and they had lots of rules. They really do. So first of all, you could talk about different interest rates, different ways to pay them back. Fixed interest rates or variable interest rates. Fixed interest rate simply means there's an agreed upon rate over time that doesn't change. A variable interest rate is quite different and has other implications, as lots of us that had variable interest rate mortgages have probably figured out over the last 4 or 5 years. Variable interest rates change based on some other rate that they have pegged it to. Generally, the rates that you'll hear mentioned are the prime rate or the LIBOR rate. And in a very simple explanation, these are just sort of agreed upon interest rates either by the financial markets or by governments. And then they may add percentages to those rates because you're a more risky loan than the average loan as a small business. And so that may float. It may go up and down over time. That can be to your benefit or it can be to your detriment depending on whether the interest rate goes up or down. Also important to understand is that when they lend you money, they don't do it without any rules about what you can do inside your business. So the bank will put down what's called covenants. They'll say, hey, look, here are the rules about what you can and can't do with this money. And these are just some examples of affirmative and negative covenants. There are lots and lots of different kinds of covenants. That could be a 30-minute explanation unto itself, but here are some simple ones. Affirmative covenants. What that means is that these are the things you have to do. You have to maintain legal existence of your company. You have to stay current with your taxes, so you can't skip out on your tax bills. You have to have insurance, and you have to have financial reports. if you violate any of these, I have actions I can take as the lender to require you not to violate these things. So you have to do new financial reports, you have to make sure that your corporation stays incorporated. Those are examples of affirmative covenants, things you have to do. These are negative covenants, things you cannot do. So I don't want you doing these things. In fact, you can't do them or you will be in violation of these covenants. Things like you have a debt limit. You know, the company can only borrow $500,000. If you borrow any more than that, you're in violation of your original loan covenants. I'm going to limit your ability to pay dividends or fees. I'm not going to lend you a whole bunch of money and then have you turn around and pay dividends to yourself and watch all that money disappear. So I'm going to put some limits on dividends and management fees. You can't merge with another company or buy another company, so you can't do any funky sort of mechanization of who owns the company, because I want to make sure that I protect my interest in that loan. And I'm not going to allow you to take liens on equipment or property or change ownership, make major ownership changes in the company. So you can't sell it, and you can't take liens out until we settle up on the loan. So what I'm trying to explain through this commercial loan piece is that a commercial loan is a lot more onerous than other potential funding sources, but it's useful nonetheless. The bank's going to have a bunch of rules about how they lend the money, what interest rate you use, and then ultimately what you can and can't do inside of your company in order to maintain that loan in good standing.